Hey everyone, thinking about a home equity agreement but not sure if it's a suitable option for you? Today we're going over 7 questions you should ask so you can make an informed decision that works for you and your finances. But first, let's break down what an HEA is and how it works. An HEA helps you get money up front in exchange for a share of your home's future value. There are no monthly payments for the term of the agreement, which can range from 10 to 30 years depending on the HEA provider. If you decide to sell, the provider takes their share of the proceeds, which is based on the value of your home at the time. You can also settle your agreement at any point during the term using another form of financing or cash on hand. For some homeowners, an HEA can be a great fit, but it's not for everybody. Here are 7 questions to answer to help determine if it's a viable option for you. 1. Do you have substantial equity in your home? If you're a new homeowner or you've taken cash out of your home in the past, you may not have a lot of equity. As a reminder, home equity is the difference between the market value of your property and any outstanding loans you may have on the property. If you haven't built much equity yet, getting a home equity agreement can be more challenging since most HEA providers want you to have at least 25 to 30% equity to qualify. Traditional loans could be an option for you, but they usually come with a tighter credit and income rules. Number 2, want to keep more of your cash each month? An HEA might be just what you're looking for. It lets you access your home's value without adding another monthly bill to your list. You get the money up front and you decide when to settle. You don't have to make a payment until the end of the term. Use that cash to tackle debt, start a project, or take control of your financial future. 3, how much funding do you need? How much cash you need can help you figure out the best way to tap your home equity. With an HEA, you can unlock anywhere from $15,000 to $600,000 depending on the provider you work with and your eligibility. If you're looking for funding in that range, an HEA could be a good fit. But if you only need $10,000, a home equity loan might be the better choice. 4, are you self employed or retired? If your income fluctuates or is limited, qualifying for a traditional loan may be difficult. HEAs tend to have more flexible income requirements than home equity loans or personal loans. HEAs may also be more appealing if you're living on a fixed income and want to avoid taking on new monthly debt. 5, do you have fair to good credit or even higher? Traditional options like cash out refinances, home equity loans, and home equity lines of credit often require higher credit scores, and the best rates go to those with excellent credit. In contrast, a home equity agreement offers more flexible qualifications to serve homeowners with a wide range of credit scores. 6, do you plan to sell your home soon? If a sale is planned for the near future, it might make more sense to cash out your equity when you sell rather than accessing it through a loan, a home equity agreement, or a cash out refinance. If you need to make home repairs before selling and have good credit, you could consider a home improvement loan from a contractor. You can also sell your home as is, knowing you may get a slightly lower price. 7, how fast do you need to access funds? If you're on a tight timeline, an HEA could be a good option. With flexible credit and income requirements, the HEA application process has less paperwork and can move faster than a traditional bank loan. While it depends on the company, you'll typically get your funds within 30 to 60 days of starting your application. Figuring out the best way to access your home equity is a big decision. If you have decent home equity and you're searching for a funding method that helps you maintain your monthly cash flow, an HEA could be worth a closer look. If this helped, go ahead and subscribe and let us know in the comments what topics you want us to break down next. Thanks for watching.